So for our capstone file project, we were Boundless Optics, me, Denman, and Thomas. Okay. And our strategic vision for the company was a lot like our annual report. Our mission was to create opportunities for all photographers who are, starting their journey, as well as for families who are a little bit of a lower income, which was a lot different from our competition. Our vision was for the company to be the one that you went to when you're buying your first camera or when you're buying your child their first camera, really starting out the first of the line or the lineage. So, and we believed that a world where everyone follows their passion, and we want everybody to start their photography with our camera. So kind of as a brief overview for our financial performance, our annual earnings per share were going up the entire time. They were very constant in their growth, as well as our return on equity investment. They were pretty consistently going up, and same with our year-end stocks. Now, we did have a little bit of a dip for about a year or two, but we were able to bring that up and actually increase it way over what our investors and what our team thought we were going to. So we kind of exceeded expectations. Same goes with our annual net sales revenue. For a while, we kind of dipped, and then we brought it back up. We actually went from around 648,416, and then we jumped it way up to over 800, which was a big jump, and the graphs kind of represent that. And then as a brief review of our annual image rating and credit rating, it's kind of the same thing. We, had a very constant kind of downhill, and then brought it way up toward the end. About halfway through, we made that upturn, and that's kind of where our stock prices, as well as our net revenue, kind of dipped, was us trying to increase that image rating as well as our credit rating. And that ended up resulting in quite a high image rating and credit rating. Okay. And then for our performance forecasting, what we forecast that we're going to do in the next couple of years. So we expect to increase and grow as we have been doing. So our earnings per share, we expect it to be around 14 in the next year and 15 after that. So again, growth, as I have shown in the chart, it's kind of just an extension of the chart that I already had. And then for the return on investment, we expect to be around 55, and then another increase to almost 60, about 59.1. Credit rating, we're hoping, fingers crossed, to keep it at an A+ rating at the very least. And then image rating, we're trying to increase that again from the 70s range to up into 80s, and then 81. And then our stock price target is to be around 309 in year 16, and then 339 in the year after. And then
all right. Yep.
Yeah.
I'll take over from here.
Yeah.
So competitive strategy, it's important. It's our long-term action plan to maintain or build and maintain a competitive advantage. And so for our AC caption cameras, our initial competitive strategy was to create a product that was inexpensive, it was affordable, but it was also offering minimal sacrifice to the quality of the product. So we still maintained a reputable image rating and product quality rating. But yeah, our priority was to keep the cost of our cameras low, and we found a segment of the market that was less saturated with competitors, and that kind of gave us the ability to make significant annual adjustments that would not really compromise our initial competitive strategy of low price and reputable quality. Due to the increase in liabilities and expenses from large investments and kind of nurturing this idea of the competitive product, our AC cameras gradually increased, and by year 14, we were offering the most expensive camera in the market. So our price was continually increasing, and by year 15, we were in a completely different segment than we started initially. So our strategy continued to adapt and change throughout. And by the end, we were positioned in a different segment than we started. Okay, and similar to the competitive strategy for the AC cameras, our UAV drones, we worked to keep the price as low as we could initially, while offering that same kind of balance and minimal sacrifice to the quality of the product. At nearly 25% initially, we controlled a majority of the industry's market share for all of the 4 regions. And moving forward, by year 15, we were offering the second most expensive product. Again, similar to the AC cameras, our price continued to climb as we adjusted with investments and adjustments to our quality of our product. So we did take a hit to our market share as well. That went down significantly by the end of the simulation. So production strategy. So we knew that we would need to increase the capabilities of our production. Our demand was increasing, especially initially when we were offering our product at a low price point. So we invested quite a bit into expansion of our facilities and the workforce stations, and as well the benefits for our workforce and the training and benefit packages as well. Towards the end, we did invest in the robotics upgrade, which did help quite a bit on production costs. And like I mentioned before, we did incentivize the workforce with training and benefits to production. I think she might have disconnected.
Yeah, I think she froze for a minute. I noticed that, so I'm sure she'll be right back. Yep. Oh, yeah. Here she comes. Here she comes. Go ahead. You should still be able to share your screen.
Can you see?
Yeah. Is the next slide strongest competitor?
Next side, company finance.
Okay.
Oh, yep. Is my mic working? Can you hear me?
Yes.
Hello?
Yes, we can hear you just fine.
Okay, perfect. So in regards to the company finances, excuse me, profitability, I just put that as the first bullet there just because, at the end of the day, that's mainly what we're concerned about. And there's a few ways to get there. When you look at our statements, we're not really big in terms of liquidity and on-hand cash, although you do see a lot of our cash is actually being dedicated and put back into the business, like Tom mentioned earlier, and in terms of expanding or increasing our workspace and workstations, while also cutting down on the workforce, but increasing the use of robotics to help increase that efficiency as well. And then to kind of make up for that lack of cash, you will see that we did take out some loans a few years, those being year 1, 4, and 10, and 11. And only one was around $100,000 in year 10, just to kind of get our cash back up. And the reason that was low kind of points towards dividends and our stock price. So generally, when you have we were kind of struggling in the beginning with our earnings per share and a few other things that the stock kind of really affects. So by issuing more stocks, we were able to, by purchasing more stocks, we were able to, sorry, just completely lost my train of thought. I'm getting them flipped around. But First we issued more stocks, and then that helped increase our cash and our ending balance for the year. But then turns out that we needed to increase our credit rating, we needed to increase our EPS, and a few other things. So we actually repurchased stocks in order to kind of counteract that effect that we had initially. So it was kind of a lot of playing around with that, but in the end, we found that happy medium because you'll kind of see we just went from no dividend at all up to 12, just not really knowing exactly what it was doing. But then we brought that way back down to $2, brought it back up to around 9, and just kind of found that sweet spot to where we sit at around the $2, $1 to $2 now. So, and all of that was just to kind of help us reach those investor expectations across the board instead of falling short by a couple points here and there. And then the credit rating, the debt versus the equity ratio. As you know, you want to be positive on that. I believe that's the one where it's a 15 to 20% is a solid range, if I'm not mistaken. But what I put here is just a quick little pivot chart of years 8 through 15. The years prior to that, as we all know, was kind of just getting our feet wet. But what you see in here in those spark charts or those spark lines to the right of that, the light points are our low points for each metric, and then the green points are our higher ones. So what this is really showing you is we continue to increase our debt to equity ratio, as well as we continue to increase our profitability. And we've always been pretty profitable throughout the whole simulation. We've actually been one of the higher profiting teams, but it was, like I was saying earlier, balancing that along with the stocks, along with, the debt that we had, the credit, and then the image rating was one of our big things too. It was trying to figure out exactly how to remain as profitable as we were in each region and keep our market shares while also reaching that investor expectations. So essentially what all these numbers are showing you is we have been, bouncing up and down, but once we do get to a certain point, we do tend to even out, and it's more of a linear trend there. So that's pretty much it for the finances. I'm trying to think if I'm missing anything else there. I don't think so.
Yep, that all sounds good. And as he mentioned, we've been kind of fluctuating up and down between two different highs and lows of the competitive market. And so towards the end of the simulation for AC camera markets, you can see in this graph here that I copied over from the simulation, we are kind of separated and had a little niche in the market where we were the higher product quality rating, and our prices had climbed significantly from where we had started. And our closest competitor here was definitely Company A, with a relatively similar price point and product quality rating. We were very close on these, the segments of the market that we had decided to kind of position ourselves in. And then our strongest competitor for the UAV drones, again, is going to be Company A. Towards the end of the simulation, just like our AC cameras, our price had increased significantly, and we were pretty neck and neck here with Company A in terms of product quality and price point. And you can see on this chart here, I copied over that we are positioned just about the same on product quality. That's just investments into advertising and retail marketing that they separated themselves from us there, but they were our most direct competitor that we had to kind of monitor and analyze their decisions to stay competitive in that area of the market.
Denman, do you want to take this slide?
Sorry, I muted my headset. I was saying, Tom essentially kind of outlined what this slide was talking about in terms of how we would what actions we'd need to take to outcompete Team A, I guess you'd say, really everyone, but Team A is our closest competitor. But like you said, a lot of it just is the demand. They sold a lot more units. Now, we can increase our demand by decreasing price depending on the area, increasing our retailer support. Another good strategy, is in America where we have the highest price point, we increase the marketing, get more views, get more information to the customers on the products, to make that price point, seem reasonable, and somewhat feasible, as opposed to maybe, like a Latin America or an Asian America where we could probably do better in terms of increasing the number of units that we sell there by keeping the price point low, and not having to necessarily worry about that, the marketing aspect of that and increasing our retailers and direct ships and things of that nature. So there's a few things that we can do. And I think that would probably be the two best options, just depending on which one for which year. I know every year in that forecast list, that's actually a really big help in terms of going up 6.4% and whatnot. But moving forward, like the years 17 and 18 and 19, that would be a really big indicator on the right strategy that we need to implement going forward. But the special contracts, we only did that one time. It wasn't a negative, we actually got one of our requests approved, so we did get a special offer. But we didn't really see it increase a lot of our numbers and our demand. So we didn't continue to move forward with that, but I did see that company A did utilize those a few more times. So I think that if this were to continue going, that we would definitely want to kind of look more so into that and see if that's another way. But if everything was to stay the same, we could also just keep our price points the same. We could increase our price points and not have to necessarily worry about that gap between our units sold. So there's a few other ways that we can kind of help fill in that gap or mitigate, the distance between us and them. But those are just a few of those examples. And the next slide.
Yeah. So overall, the Dynamic Views and Aphrodite Camera Company were our two biggest competitions, as we've kind of discussed. The Dynamic Views, their investor expectation was around 105. The best in the industry score was 92. Their weighted average score was around 99, and their overall kind of score was 107. Where Aphrodite Camera, who was right underneath us, was at 102, 94, 97, and 105 respectively. We were very, very close to Aphrodite. Actually, we were pretty neck and neck with them overall with the scores. However, Dynamic Views, who ended up beating us, just kind of really beat us out in the investor expectation score and the weighted average score. We were very close with Aphrodite when it came to those scores. So for future reference, we would want to go ahead and look at their scores and, like Denman and Thomas discussed, kind of look at our better options and think about increasing price point and look at those special offers. Thomas, did you have this slide?
I did not.
Oh,
type
sorry.
this slide. I can.
Sorry. No, that's me. I keep muting my gaming headset and not unmuting this, but I was saying the lessons learned from this, the Glo-Bus it's just we all agree that it's just an amazing program. I'm not sure if it's accessible to just any and everyone or if it's just strictly related to schools, but a few things that we learned is as a manager, you should do detailed research at the market before pricing the products. The market forecast and monthly performance reviews, they're key. Kind of like I was saying before, the forecasts are going to be key to knowing where you need to go. And then you can use things like Excel or any other equations you might know in terms of forecasting, a growth trend, a linear trend, or anything like that. Um, and then also you can utilize all of the information and stats that they give you based off of your previous years and your competitors' previous years. So, I mean, and I guess this is all real life, but in the day-to-day life, like you can use Yahoo Finance to dive into companies' books like that. I know that's free, something that's easily accessible, but it's really nice to have um, all of this wrapped up into one and kind of see exactly what the changes that you implement, what effects they'll have on the overall company, the bottom line. So also as the price changes, many other factors change as well. And we kind of found that out a little bit later, we were trying to figure out, okay, how do we get the best camera? And okay, now which region do we need to focus on? Okay, do we need to just figure that out by ourselves, or do we really need to look at everybody else's first, or like what comes first, So it's just kind of just learning as you go. And it was a really enjoyable process in that regard. And then lastly, another lesson is, or excuse me, lastly, the key isn't to have all the equations and information memorized. I know every week I had to click on that help button just to kind of remember exactly what everything was and where they were pulling this from. Like if we're trying to get the credit rating up, which we were struggling with in the middle of the simulation, or we're trying to get our image rating up, which we were struggling with in the beginning of it, while also not dropping down everything else too much. You really have to kind of go in and read like, okay, this is how we do that without affecting this, and then continue to play with that. So it's just key to not try to memorize everything, but have it accessible for when you do need it and know where you need to look. So this whole simulation really helps out with that, So when you do encounter that in the real world, you're not just starting from scratch. You're going to actually have a reference point. So that's a beautiful thing. And then other than that, that's pretty much, I'm not sure if anyone else wanted to put any takeaways in there, but I know I personally really enjoyed the finance aspect of it, just because, like, theoretically, we all kind of know what, oh yeah, you buy more stocks, okay, yeah, you're going to get more cash because people are paying in and stuff like that. But the repurchasing of stocks, the dividends and the effects that they have on it, just the equity, we wanted to make sure our company had greater equity as opposed to cash flow and liquidity, cash on hand. And that's why we took out those loans to kind of just make sure that we could get all of our structure together for the company, anticipating that further down the line, if this was to go on for 5 more years, that once those loans are paid off, and then our liquidity would start to increase, because that cash that we have been spending towards paying back these 5 to 10-year loans is now just going to be money in the company's pockets. So, I mean, it's just really nice to see all this stuff, but I'm not sure if anyone else wanted to add anything in terms of the lessons learned, but that's about it.
No, I think you covered the majority of the points that we had.